I'm Lexy Komichak, real estate agent with North & Co. And today I am sitting with Kyle Sebestyan with VIP Mortgage. He is one of my preferred lenders and wonderful, especially with my first-time home buyers. So we're going to ask him a few questions. Hopefully this helps you as you go through your process. And Kyle, give us a few tidbits on you.
So yeah, Kyle Sebestyan with VIP Mortgage. I've been in the lending industry for about 5 or 6 years now, give or take, and really enjoy working with first-time home buyers, educating and walking them through the process, kind of holding hands with them and answering all their questions. And our goal as a team is to make the client feel comfortable, and the best way that we know to do that is to make sure that they understand everything from front to back, A to Z, about the process, and that they don't have any other questions.
So on our last videos with Heather, she's a financial planner, and one of her recommendations for first-time home buyers and millennials was to sit down with a lender before they even start the home buying process. And I know personally when I meet with clients or they reach out to me about looking for a home, I always tell them talk to a lender first before we even start, because I want to make sure that we're looking not only where they're comfortable, but also where they're qualified. So if we find the perfect property, like, we can start moving. What would you recommend to first-time home buyers?
Well, I would say, first of all, that Heather sounds incredibly intelligent, because that's what I tell everybody as well. Like, even if you, like, everybody knows a realtor, and so they're gonna probably know a realtor before they know a lender, or at least think of, they're gonna look for the house first, and then they're gonna say, oh wait, can I afford this? So a lot of people go about the process in the reverse order, but the correction happens with you, I guess, is where they start to get serious about the process, and then you redirect them. Okay, but you need to talk to a lender first, and that's exactly the right thing to do, because it would be like going to the mall or going to the grocery store and knowing that you needed, food or whatever for the week, but that you didn't know how much money you had in your wallet.
Totally.
So you have no clue how much money you can spend for that week on food or whatever. So our job is right up front to give you guys a budget for the home buyer to shop with, not only their maximum qualifications, because last week I qualified a client, first time home buyer, and she wasn't even sure that she would qualify at all at first. Then we determined what her comfortable monthly payment would be, which, let's just say, for example, it was $1,500, and that was about $280,000. Now, with her income, she actually qualifies maximally for about $400,000. And so the difference there, obviously, she's not comfortable with that $400,000 payment, but you know that she can go to that. But her comfortable budget is about $1,500, which is $280,000.
Which is awesome.
Yeah, and so armed with that information right there, now you can go out, you can make informed decisions and form parameters around your searches for homes, and just increase your efficiency as a realtor and narrow down the search for your clients.
I love that. What other factors do you take into consideration besides just somebody's income and their comfortable budget? What other things are you looking at when people come and sit down with you?
So really the easiest way to explain it is, I tell people there's three parts to a loan. There's cash, credit, and income. Cash is just, do you have the amount of money available needed for the down payment, the closing costs, and things like that, and possibly any reserves that may come up if it's, say, an investment property or something like that. But for a first-time home buyer, we're really looking at cash as down payment and closing costs. Okay. Credit, obviously, do you have the appropriate score to qualify for whatever program best suits you? Okay, so FHA, conventional, VA, whatever the program may be, they all have different credit score requirements. Income is, all we're looking at there is the amount of income that you bring in monthly versus your amount of money that flows out each month. So your debt to your income ratio. So for example, if someone has $10,000 a month in income and they have $5,000 a month in debt, then that's a 50% debt to income ratio, right? So that's how we calculate that. And all we're looking for, actually, when we're talking about a debt to income ratio, are minimum monthly payments for whatever their debts are. So if someone has $100,000 worth of student loans, but their monthly payment is only $200, we only care about the $200. That's where a lot of people get confused as well, because they have a lot of credit card debt or large student loans, and their payments are low, but their balances are very high, and they think they have too much debt to qualify for a home.
That's actually going to be one of my questions was, especially as millennials or becoming first-time home buyers, we all have so much student debt, and then we're buying cars and we have animals and starting families and all that kind of stuff. That really does answer my question about where can we go from there. And does it sometimes help to have like maybe one, if there are two people together, is it sometimes help to only have one qualify for the loan? And if the other one has more debt or whatever their circumstance may be, is it in their benefit to maybe split it up, or is it better to look together? What would you recommend?
It really it all depends on the exact scenario, and every borrower or borrower pair, every loan is different. It's as unique as a snowflake, you know. And so the situation will differ from person to person. And I actually had this conversation with someone earlier today, a new agent, and he was asking me, you know, he's got a couple of clients and they're not married, but they both want to be on the loan. Does that affect whether they can get a loan or not? And it doesn't. Depending on the loan type, it could be advantageous or not to be married or not be married, or to have one or both of the partners on there, just depending on the amount of income that each person brings to the loan file versus the amount of debt that each person brings to the loan file as well.
Okay, cool. So that's something good to consider. Any other things that that first-time home buyers should be thinking about when they come talk to you? Or I don't know, I'm trying to think of all the different scenarios. And
yeah, no, I mean, I think that it's better to ask than to speculate, to know exactly what you're getting into, and to have hard, solid information, and not just to go look at things on the internet, because most of what you're going to find on the internet, especially related to loan programs and requirements and things like that, most of it is either outdated or incorrect. A lot of times people are going to hear things from their parents or their grandparents about buying houses that may not necessarily be true anymore. So.
That totally reminds me. Yeah. So the biggest misconception I run across all the time is everybody's like, well, I don't have 20% to put down. Right. And so that's something that I usually tell them, hey, you don't really need that, but I don't know your financial situation. You should probably talk to Kyle and understand a little bit better what that looks like. Yeah. For a first-time homebuyer, like we do have first-time homebuyer programs. They're low percentage or low percent down for a conventional loan. Like as somebody who's served in the military, there are VA loans. So like there are just way more options than 20%.
Absolutely.
Right?
Yeah. And you know, that's the thing. I've actually very rarely nowadays see anyone put down 20%, because I think the average home price in Phoenix, Arizona is $247. You know, 20% of that is, you know, $48,000. There's not many people that just have $48,000 or $50,000 sitting in an account ready to go, unless it was gifted to them from a family member or they inherited it or something like that. Because like you said, a lot of millennials, younger folks like us, first-time home buyers these days, have an excessive amount of debt, whether it's through student loans or, you know, we like flashy things. You know, we're seeing all these people with these great vacations and cars and houses on
Wait,
Instagram.
flashy things? What?
You know, I didn't wear all my jewelry today, sorry. But no, so yeah, it comes down to, you know, people just don't necessarily have the means to put down 20% anymore. And the great thing about that is, you know, not everybody does. You can go 5% is standard on a conventional loan, 3.5% is standard on an FHA loan is the minimums, but there are caveats to conventional loans, like our Home Ready product that we provide here at VIP, and you can go as low as 3% down on that.
That's awesome.
Yeah, it's super, super affordable to get into a home. And really what I look at is when someone rents, say, an apartment that they're paying $2,000 a month for anyways, you know, they're going to give a month or a month and a half worth of rent up front anyways, plus their first month. So that's 2, 4, 5, that's, you know, it's about $6,000 anyways. I mean, you're almost there at 3% on a $200,000 home, you know. And so it's quite affordable, and especially if you look at it in those terms. Plus, you know, down payment funds or can come from a lot of different sources. You can bring them for your checking or savings if you have that saved up on your own. You can get a gift from family, friends, relatives, organizations such as a church. You can get it from an employer, places like that. Or we can liquidate retirement funds, which, although a lot of us, you know, don't have a lot of cash on hand, some of us have a small 401k at this point, even early on in our careers.